guest. Joining me right now, Morgan Stanley Senior Vice President and Senior Portfolio Management Director, Jim LaCamp. Jim, always great to have you on this program. So can you answer that? Does the bull market keep roaring next year?
I think so, Taylor. It would be very unusual for a market to stop when interest rates are falling, especially when interest rates are falling with the market at an all-time high. That's a very bullish signal generally. Earnings expectations are rising. CapEx plans for businesses are rising. Share buybacks are still very strong. And it looks like the Fed, they probably won't cut in January, of course, a brand new Fed chair, but the Fed funds futures are suggesting more than a 50% chance of a rate cut in March. And we need that. We need it particularly for private credit, private equity, and particularly for the housing market as well. But I think we'll get rates coming down. And the other thing to remember, even though the second year of a presidential cycle is typically a little rockier, we have a lot of things coming at businesses that are good. We have the several aspects of the big, beautiful bill that are business friendly. We have deregulation kicking in. And so there's a lot of things that are positive drivers historically for the markets that are in place. So I think we can rally. I don't think it'll be as much as this year or last year, but I think we'll see positive gains.
Underpinning this, you talked about the Federal Reserve in play. I'm taking a look at a very stable 10-year yield, a very well-behaved 10-year yield at just a 4.13. Does the calmness of these bond markets in the last couple of weeks, does that bode well for next year?
Typically, you like the markets, the bond markets to be calm, and actually the stock markets to be calm. And the reason is there's an old adage out there on Wall Street, never short a dull market. And the reason for that is it brings low volatility funds into play. They add more money to the markets, and they feel more confident about doing that when the bond market isn't all over the place. I do think, though, that this is a major concern for next year is whether the longer rates are going to play along with the shorter rates, because that's what is going to impact the housing market a lot more, and a lot of deal flow will be impacted. But they need, and we need, longer rates to come down. It's a big question that needs to be answered. Inflation picture is a little muddy. Looks like it's improving a little bit. Deregulation should help that. Low oil prices should help that. But it's still a question that needs to be answered. The other concern I have, Taylor, is everybody on Wall Street is bullish, and usually.
Can we talk about that? Because I asked that question on the earlier show in the noon o'clock hour. It makes me very nervous when everyone on Wall Street, all the big major investment banks, are looking at anywhere from 7,200 up to 8,000 on the S&P 500. So everyone is pricing in gains. Does that mean it is a one-side trade, and does that worry you, or is it good? Everyone's optimistic.
Well, it's a double-edged sword, but it does concern me a lot because you always look to where is the pain trade. Where's the trade nobody's looking for? The pain trade is that the market would sell off. And again, historically, it does do that in the second year of a presidential cycle. Now, you might be asking, why? Because there's a lot of positives going on for this market. So two concerns would be maybe valuations or something that we're not thinking about yet. Maybe another government shutdown. Who knows? There's any number of places that a market speed bump or road hazard or even volcano can happen. You just don't know where these things come from a lot of times. And when the market's very richly valued, or more sensitive to those kinds of disruptions.
I think some people, and this is a question for you, would push back on valuations. One argument I hear is, yes, maybe it is richly valued, but when AI has done a structural shift in the economy, it deserves a higher valuation, some of these AI stocks, because again, this is the fourth industrial revolution. This is not like the dot-com era where none of these companies were profitable. They are changing this economy, and they are changing it structurally. Does that command an inherent higher valuation? Are you okay with a higher valuation given that scenario?
That's a great question, Taylor. And the reason it's great is you strip out those 10 companies, the market really isn't at historically high values. And we're seeing some rotation in the market, the financials, the industrials, basic materials, even the mid caps. This is healthy. A rotation in the market is healthy. But getting back to the data centers, the AI trade, if you look at CapEx plans, that's where all the money is flowing. That's where a lot of the hiring is happening in the economy. And yes, that is where a lot of growth in the markets is happening. And I had a client ask me the other day, he said, do you think we should sell all our high PE stocks? And I said, well, you could, but if you do that, you're selling all the stocks that have the best growth prospects out there. So you might want to rethink that. And again, the spend for AI and the CapEx plans for businesses in this area is still very solid. Yes, there are concerns and there's a lot of interdependency between these companies and there's a lot of debt involved, but lower rates will help that from the debt side. So I think the trade is still intact. These are real businesses. In the dot-com bomb era, yeah, a lot of those were not real businesses at all. These are, and so I think you can still be in these names as long as you diversify that portfolio a little bit and have some of these other areas. And there's a lot of adjacent areas too. Space is an adjacent area. Robotics is an adjacent area to AI. And these companies are all doing very, very well and with very solid earnings profiles. And overall, it's a very good backdrop for stocks. And again, one of my concerns is really just that the sentiment recognizes that and may not be factoring some things that might come from out of the blue.
Finally here, I want to touch on some dollar weakness. Now, we know that traditional math is pretty simple. When the dollar is weak, big multinationals, I'm thinking the big companies in the S&P 500, they get sort of an artificial boost in earnings because when you translate all of those earnings overseas back into a dollar-denominated balance sheet, it looks better. And so you have higher profit. Do you like dollar weakness or would you prefer more dollar strength and stability in the dollar?
You know, that is a great, your friend and mine, Larry Kudlow, and I have gone back and forth.
I know.
And you like the strong dollar because it means more money flows into a country that has a strong dollar. On the other hand, as you've pointed out, a very slightly weakening currency, a stable but slightly weakening currency can really help our exporters and allow our multinational companies generally benefit from that. That goes right down to the bottom line and that helps earnings. And the markets usually do a little bit better if the dollar is just slightly weakening. And long term, you like the dollar to be fairly strong. But look, we're printing a lot of money in this country, and everybody else is too. And that's why these metals and these natural resources and all these anti-dollar plays, even the cryptocurrencies have done fairly well. And I think the metals will still be a play for next year. But I do think the slightly weakening dollar will help the large cap stocks for next year.
Well, I love having you on this program. You're going cross-asset for us. So smart. Jim LaCamp, thank you. And see you next year.
Looking forward to it.
All right.